Let me text her real quick. All right, Chris, we're live. Good morning.
Good morning.
And so I want to welcome everyone to MMBBA Live. I'm Sean Williams. I'm your host and the current president of the Maryland Mortgage Bankers and Brokers Association, or MMBBA. And so with this, each week we bring timely conversations focused on advocacy, leadership, and issues impacting our industry here in Maryland. And so today's discussion is one that impacts every part of the loan process, from origination to closing and beyond. And so also kind of hot off the presses, yesterday we had an announcement in regards to some credit, and we'll get to touch base on that too as well today. So, Chris, I think our timing was perfect, and so you know, with that said, I'm pleased to be joined by Chris Palermo. Chris is with CIC Credit. Uh, just real quick, Chris brings a deep background in banking and the mortgage industry. He's held leadership roles across lending organizations. Chris also serves with uh, us on the MMBBA board, and Chris is the vice president for our executive council, and is the founder of the Foundation of Adolescent Credit Education. He's also working every day in the credit and risk management space as the industry continues to evolve. So, Chris, before you introduce yourself more, before we jump into the conversation, the way we start every show, the same way. Give us a fun fact about yourself. What's one fun or unexpected fact about you that most people don't know but probably should?
Well, I was going to say the foundation, but you mentioned that already. So,
I spoke there.
um, people don't know the fun fact that how it started was that in '08 during the crash. So I was an originator in '94, opened a branch for a mortgage company in '99, had that branch till 2016. But in 2008 during the crash, I wrote a book called Freedom Day, and it was a book on basic financial literacy and the life process that I dealt with to learn everything that I learned in the personal finance space. And I gave it to a friend of mine who's a PhD in education. He said, it's not enough to publish, but this would be a great course for kids. So I worked with him and started a foundation. So instead of just trying to create the course, I went the extra step, created a nonprofit. And to this date, we've probably taught over 15,000 kids that course. I've spoken at Temple University for the last 10 years and several high schools in the Philadelphia area for the last 10 years
Oh
on it.
wow! So it's
Yeah.
based in Pennsylvania and Philly,
In the
in and
Philly
around the
area.
area.
Yes. I'll go visit any high school around that wants to hear our course. It's free to any school that wants it. It's just a 2-hour seminar that we give
And
in person. We won't do it like this. It's very important for us to be in the classroom.
I see, I see. And tell me again how that started. Like what made
Just
you do that? Decide to do it again?
so my first job, I worked at MBA America, the credit card company,
Yeah.
and I sold credit cards at universities. So when I became a mortgage guy around '08, I'm turning down 20 something, young 30 something after young 30 something, and it's because of their credit card debt. And nine times out of 10, it started in college. And I was like, I felt like I was part of the problem. So I decided to become part of the solution and started writing a book and then created a course.
That's pretty neat. That's kind of thinking back on my mortgage career and like why I was really passionate when I got started is because when I would go in the chow hall, whatever it is, and the commons at my college, there was always somebody there with like a clipboard and a T-shirt, and
Mhm.
they wanted us to apply for credit cards.
I was one of those people back in the day.
Yeah, and I took
Very good
every.
at my job.
I
I
took.
think.
You didn't even have to like say anything to me. It's just like, all right, cool. I get a free T-shirt. Oh, and you're
Yep.
gonna give me some money.
Yep.
And just not realizing that you expect these companies expect to be paid back. They're just banking on the fact that you're going to get a job when you get out of college and be gainfully employed and pay them back. Let's just say I wasn't the most responsible person, and that part kicked my butt. And when I went to buy my first house, I realized that I probably should have done a lot better with my credit. And so once I started to understand it, and someone kind of explained to me how it all worked, because I didn't grow up learning that stuff. I haven't looked back since, but that's a pretty cool story. I'm glad you're doing that.
Yeah, and it's nice when you're out at dinner in your town and a kid that you taught like 4 years ago comes up to you and says, "Hey, Mr. Palermo, I was in your class when you gave it. That was so good. I learned a lot from it. It's really helped me through the beginning of my life as I go to college and start working." I was like, "Hey, that's great." So that's why we do it.
That's awesome. That's good work. Good work. Thank you for that. I mean, we had a few questions that we were going to cover, and I think will still be able to do that today. And before I get started, I wanted to thank Bay Capital Mortgage. I want to thank CIC Credit, as well as CMG Home Loans for being our sponsor for this MMBBA Live. It's something that we do three weeks during the month. And so just appreciate your support on that. But something happened yesterday. I see a lot of people online pontificating, and there's so many experts overnight on how this thing is going to
Mhm.
work and should work and how we got to this point. But you're the expert. Fill us in on what just happened yesterday.
So Freddie Mac's going to accept loans with the Vantage score. I believe they've with a specific set of lenders in a pilot program. Okay, so I believe that Freddie Mac worked with these lenders to create some kind of pricing model so they can actually originate a loan with a Vantage score, close it, fund it, sell it to Freddie Mac. So that's got to be tested. I'm going to say the whole process, time frame wise, is going to take a while with all the POSs, LOSs, the servicers all have to get a grasp of what is the risk and value of a loan that has a Vantage score as opposed to a FICO score. So that's where they're getting into now. They have an idea, but I think once they put it in that pilot production, they'll get a better feel for it. But if you look back to when we started accepting soft pulls through AUS, they started out with a set of big lenders as a pilot program. That took approximately 3 to 4 years to really get to everybody. And I think this will take that, if not more, because it's more complicated. So for the everyday lender right now, you can't, if you're a broker or if you're an IMB and you're not part of the pilot program because you're not one of those bigger lenders, it's just business as usual right now till that pricing goes out and gets spread out to everyone.
And how many lenders? I've seen different numbers, but like how many lenders we think going to be in that pilot program initially?
I don't know yet. They did have something in their press release that said if you wanted to be part of the pilot, please contact your Freddie Mac representative. So,
I
but
see.
I'm uncertain as exactly how many people are in the pilot program and who they are.
Got it. And like for companies like you guys, and we'll get into that later as well. But like, how does this affect you and how you do business with your partners?
So it's only going to help us because anytime we get to talk to our customers about new stuff coming to the market, it just helps build our relationship stronger. But also, we deal with credit in other industries besides mortgage that utilize Vantage Score already, So our technology is already able to deliver the Vantage score today.
I
So
see.
if there was pricing today for Vantage score that all mortgage lenders could use, we could add it to their credit reports tomorrow. Like it's already there. It's already ready to deliver. What happens is we deliver the credit score, the credit report, the Vantage score. The pricing models have to be created. The underwriting systems have to be adjusted. The POSs, the LOSs, all the technology and all the back end stuff has to be ready for it. And that's what I think they're getting close to now, and that's why they're opening a pilot program to those lenders to start that process.
To start the process to work
Yeah.
through it so that our industry can have some standard operating
Yeah.
procedures, I'm sure.
Right.
Yeah, and there's compliance that works through this as well. So it's like you said, it's not an easy fix, like
Right.
immediate. So I'm anxious to see how that's going to go. My last question around this is, there's tons of talk, and I'm sure I know you've had to deliver quote unquote bad news for the last few years here to your clients with increased cost and such for credit reports. They're just, if I could be honest with you, they're outrageous. Like they're just super expensive.
I don't disagree with you. I agree with you. They're super expensive. And, the first thing people say is, well, how much is this going to drive pricing down? Well, you got to realize that the score is about 25% of the overall cost of the credit report, right? 25 to 30% of the overall cost. And then Vantage score and FICO score, they're private entities with not really any regulation. So when they say how much is it going to drive price down, I don't know. The market's going to have to determine that. Okay.
I see.
Does it really become a battle where it's just like, all right, well, we're going to do it as cheaply as humanly possible? Or is FICO going to say, nope, we're going to stay with this because we're the predominant score? Vantage says we're going to get in the market, but we're not going to discount it 100%. You got all these numbers getting flown around, like 99 cents for this. If you do that, if you close a loan, it's this. So all this is being shaked out right now, and it'll land in the market. But once Vantage score becomes viable, we'll know what that pricing is, and we'll see its effect. I would love for it to come down. I'm a mortgage guy by heart. I was a mortgage originator and branch manager longer than I've been in the credit side of the business. And when I see the cost related, it's tough.
Yeah.
I feel your pain.
Yeah. So speaking of mortgages, right? From your perspective, and we kind of touched on this earlier when you told your fun fact, but from your perspective, like why is credit such like a foundational component of mortgage in the lending process?
Well, it's one of the best ways we have to identify risk. Okay. The credit score along with the whole report itself. I mean, prior to credit scores, credit reports were being generated, and the underwriter would actually look at the credit report and read the trade lines and see how many times they were past due and make a decision. There was no automated underwriting, right? Your credit reports have been around a long, long time. So you just got to remember their purpose. It's the best way to identify risk. If I'm going to lend you $500,000, I want the best possible data to make that decision. And that's where we fall into place. And then the technology with the scores, it just helps identify all this stuff. But that's why it's a big cog. It's the best way to identify risk. And the scoring model makes it easier so that an underwriter doesn't have to look at every single credit report on every single file. I mean, let's face it, you got an 800 credit score, you don't have to look at the credit report that much. That's a good risk. That's
right.
So, and when it comes to Vantage score, they got to figure that out. Those ranges out as far as is a 760 FICO score equal to a 740 Vantage and whatnot. Or even on the lower end, they talk about how many more people can get approved for a mortgage now with the Vantage score. Well, if you're a company that doesn't use Vantage, you use FICO, you're a direct lender, you're still going to use FICO. If you don't use the Vantage score, is there some kind of disparate impact issue there? That's a whole nother problem that's going to have to get worked out by this.
Right, because those models, those models don't work exactly the same. Like
No,
you're not going to come up with the same exact score one model versus the other,
correct. So
and the data it might not
it
even be the same.
affects price, it affects eligibility. So all that has to be figured out as well.
I see.
There's
I
got to
see.
be some guidelines set.
And so, like in a general sense, like companies like CIC Credit, like how do you support lenders and other financial institutions in managing the credit risk? 'Cause that's one of the things I wrote down when you just were speaking about that, and making informed decisions. So, like you're obtaining new clients, but also the customers that you currently have. Like, how do companies like yours support the lenders and the financial institutions in managing the credit risk, and again making informed decisions?
There's many different ways. We do portfolio monitoring for some of our larger clients. We're there at a consultant basis at all times when all these changes are coming about. So it's really being a true partner on that piece of their overall risk management process as far as lending. So you got to, the specific question is, are you talking about on the origination side? Are you talking about the funding side? Are you talking about the servicing at the end? There's different clients we have for each of those. And then other markets, we have certain clients that don't do mortgages at all. They just do home equity loans. How do we service them? So to give you an example, as far as Vantage, we have a home equity client that they use Vantage Score. They don't use FICO anymore. They left FICO a year ago, and now they're using Vantage because it was available to them, and it was a little cheaper.
I see. I see. And so how did companies like yours, because I mean, obviously CIC Credit's not the only company that helps mortgage organizations with getting access to this data. Like, how'd that all come about? You know what I mean? Like, how did these companies start to evolve and sort of reselling credit?
Ah, that's a great question. So Fannie and Freddie require a tri-merge credit report. Okay. All the three bureaus are independent. So the resellers came together to grab the reports. And back in the day, they used to get the report from TransUnion. They used to get the report from Equifax, Experian, and then they used to just type them all together. That's old school, but that's how it started. And that's
Yeah,
how the credit reselling business kind of started, because you wanted one report that had all three bureaus in it at once. And then they would make sure they matched the trade lines, and then you would get it delivered to you. They would deliver your credit reports to you that you ordered after they were all typed out. And then technology started to advance, and then people had a dot matrix printer they would all print out on.
oh wow.
And then with carbon copies, so you could you have one, the investor gets one, the servicer can get one, stuff like that. And then now it's all with the advances in technology, which makes you think the prices should have gone down for these things, not up.
Yeah,
You click a button and it all just imports right into your LOS now. That
it
was a big
does.
that was a big step. So I would say, oh gosh, in the 90s, I'm trying to think about the exact year or so. In the 90s, the integration came into the LOSs where you can order a credit report and it would fill out all the debts for you, when you used to have to write all the debts in by
Yeah,
hand off the credit report. That was a big step for any originator. And then it just advanced from there.
yeah, it's so efficient. But speaking of advancements, like it's what I've learned over the years is not just credit either, because that data is leading to additional things that we're looking for, like identity verifications.
Mm-hmm.
Um, I'm noticing like fraud guards and fraud prevention, and then just the whole analytics around it. And so, like, what role do you all play in something like that for the lending environment today?
Say that again, Sean.
Like, what role do your companies play in the lending environment? Because we're starting to talk about identity verifications,
Mm-hmm.
right? We're talking about fraud prevention and like
Right.
certain data analytics. And what I was saying is that it's not just now, it's not just about credit anymore.
No,
Pulling up
no.
the data to look at your score. There's things that lead additionally into that, to be
Yes.
able to do further checks and balances. And so, like, how's that all work?
So there's identity cross checks to help verify an individual within the credit report itself that we run on every credit report that our customers get. There's also fraud products that we resell that all the most bigger lenders use on every file, where it does a fraud check of the entire information in the application of all the people involved and um, some of the numbers and stuff like that. So it gets pretty intense. And we're the provider of that as far as the reseller. So it's nice to go to one company, you can get all that stuff at once instead of having somebody do this over here, having somebody do that over there. We can provide um, all your services through the entire, and any credit reseller can do this, all your services throughout the entire loan life cycle. So credit,
And what
flood, fraud, tax transcripts, S89s, VOEs. You can go to a one-stop shop for that, or you can go separate if that's what you choose. But we can become an integral part. There's some customers we do everything for them, and
Yeah,
there's some customers we just do one or two. It's really their preference.
I see. And so what is so I'm just asking personally because I mean I understand it, but I think it's important, especially for companies and originators to understand like what specifically is fraud guard, why do we do it, and what are they looking for?
Um, so Fraud Guard is one of the products out there. There's another one called the ADV 120 from Pitchpoint, and these are just the three that I know of that are the most prominent in the industry. And then there's Data Verify. Okay, they all do similar functions, check similar stuff, check the do not use list from Fannie, Freddie, and if you have a preferred list of vendors, um, if there's any foreclosures, other properties, liens and judgments you can attach to it. It's pretty intense to where anything that you could find out about the people involved in this transaction, you can find out. Does that answer your question?
It does, and I want people to know this too because things have evolved and changed. Like back in the day was sort of I say back in the day. I started in 2005,
Mhm.
nearly 20, a little over 20 years ago, and the wild wild west. And there were some things that people were getting away with that uh, you never get through it today. Like, and there's that these checks and balances that they put in place, and so really for me like a warning shot for originators and homeowners and companies and buyers and such to just be careful and just do the right thing and practice the highest level of integrity,
Mhm.
um, because there's really not much you can do these days. I mean, people still try to get around it, but to cheat the system,
Mhm.
it's just number one, it's not worth it. Number two, it's not right. And number three, chances are you're gonna get caught.
Well, what the advancements in data that we have from even like 10, 20 years ago, I mean, you can't do those people can't do any of the things that they used to get away with. Like it's all caught now. The data is so good and so fast. Nothing really get nothing really gets by. I mean, if you know any examples, I'd like to hear them, but I don't see any. And the biggest fraud right now is not on the borrower side. It's more on like the funding side. Wire fraud is a huge issue today,
Yeah, yeah,
you know?
yeah.
And you have all these viruses and computer hacks and all that stuff. That's the scariest thing at all. It's not the borrowers, it's not a borrower thinking he can lie about his income anymore because that's going to get caught instantly anymore. And
Yeah.
then, but it's more the technological risks that are the biggest thing.
Got it. Got it. So I know you're an expert at answering this question. This is a softball, the easiest question I've thrown at you
Thank
so
you.
far. Chris, I remember my credit reports used to cost $20 and now they're 7,000. I'm just kidding, but now they're like as much as $100 or more. And like I'm seeing credit packages now like $300 that includes all these services that you're talking about.
Yeah.
Like I know you get these questions all day, every day. Like, what's the response? Like, what are you telling people?
So we're a credit reseller. Okay. We do not really set the overall range of pricing in the market. We set pricing for our clients, yes, but we have to pay for the bureau. We have to pay for training. We have to pay for Equifax. We have to pay for Experian. They decide what those increases are, not us. So in that respect, it's my answer to that is you have to ask them.
Yeah, yeah.
So I'll just give you a real example. Tri-merge soft pull that you can run through D or LP today is about, $65. We'll just say 66, 67, somewhere around there between 65 and $70. Back in 2023, that cost $15.
Right.
I can't explain that. You would have to ask them why it's so much more. What technology they had to do, what advancements they had to do, what investments they had to do that caused the increase in price.
Yeah. And then how about like what tips and tricks are out there to like for people to balance costs? I remember I previously at when I had my brokerage, I had it set up where I would pull like if a credit score was below like I think 580 or a certain number, it would only pull one of the bureaus or two of them or something like that. It would just stop. Right. I think it was one bureau. And then that cut my cost like into like a third or something like that, right? Are there other tips and tricks? Like, what are we missing out here? Are there things that we can do to balance our cost and compliance and like risk mitigation in general in this environment?
So we'll go back a few years because that's a great question. And I like it because it's changed recently. So a few years ago when soft pulls were inexpensive, instead of doing that, what we call smart select tier process, where if you get a 580, it stops. Okay. Well, that one bureau was costing $15, $16 by itself. We could give you a tri-merge soft pull for that same amount and you get all three scores. So you would use that to stop your losses and stop that hierarchy process. Then the soft pulls became so expensive that hierarchy process is now getting implemented back in, not only on the hard pulls, but on the soft pulls.
Right.
To help save money.
And even then you could, so for me, I thought it was helping to an extent, but where it was hurting is when you're taking those soft pulls and you're converting them, now you're paying essentially for two credit reports.
Now you're
And
paying for more.
Because
Yes.
you couldn't do you couldn't run AUS
Right.
with the soft pull.
Back then you could not.
Yeah.
But they were inexpensive and you would get all three scores. Because what we found a lot when people do that tiered process, you pull somebody's credit report, you get a 579. What's the first thing you're going to do?
What say again?
If your minimum credit score to fund a loan is 580 and you get the one bureau and it stopped at 579, what are you going to do?
You're not going to move any further. Or you're going to try to so I probably would try to pull to see if I can get, because I'm only 1 point away and I'm thinking, all right, cool, I can help them increase their credit scores to get where they need to be. Or maybe this is the lowest, right? And now I can get a middle score and a high score from the other two bureaus. So I'm gonna try to pull the whole thing.
Right.
If I'm that close.
That's what happens. That's what almost always happens. So if you get a score that's close to that cusp that stops, the loan officer is going to go right back in and grab it and get those other two.
For sure.
So they can see if they have a deal or not. And that's where the ineffectiveness, although that process works great for, if somebody comes back with a 525 or a 480 something, then you're not going to do anything with that pretty much, except guide the person on how to get their credit better. But when they're close, you're going to pull the other ones.
I see. And I'll ask you a couple more questions, but now since we're talking about it all, I wanted to know, like, as it relates to like rescores and such, like how accurate are like the simulators and the annual analyzers as far as it's gone for me in my career. They've all been pretty accurate, right? Yes. But if it's something that's like there's things that are outside its scope and outside my scope where you don't want to rely on that, but they're pretty accurate. So like, can you confirm that? Like those analyzers and simulators, and are they good business practices for companies to use to help the borrowers improve their scores?
So they're great tools as long as the person utilizes them knows how to utilize them properly.
I see.
So, which we can always give guidance on at our company. But to give you an example, you're a loan officer, you're trying to get 20 points to get from a 605 to a 625 because that's a big price difference, right? But you don't know what you're doing. You go in there and you're just constantly doing scenarios. And then what you don't realize is that every time you switch bureaus or add something, bro, you could be getting charged. So now it's adding to your costs. And then some of the models make you do all three at once, but they charge you a lot more money.
I
So
see.
the cost effectiveness of it is only good if you know what you're doing. So where we come into play as credit resellers, we have credit experts. We do rescores for our clients and all that stuff. We have a whole team that can do those for you. I don't know if any other company does this, but we do. And they're experts at it. They do it all day long for our customers. Instead of you wasting 45 minutes trying to get those points, they could do it in 5 or 10.
I see.
And it saves time. I was sitting with a new client the other day. He goes, all right, can you show me how to use this simulation thingy? I'm like, yeah. Email what you want to this email address, and it'll come back in 5 minutes.
That's how you use it.
But I mean, don't get me wrong. I did go through the simulator with him. It's not that hard. It's pretty easy. I'm like, here, you click here, you click here, you click here. Once you're in, you can kind of figure it out. But if you get a real complex one, you don't want to be messing with it for 45 minutes trying to figure it out.
Yeah. No, those things are really accurate and can be used for some good, even for people that qualify and that are already in a mortgage. But like we're talking about, to go from one band to the next could affect your pricing in a pretty big way. So
and that's just for, I want to be clear, that's just for people that you've already taken an application for that you're trying to get approved for a loan. A lot of times I hear people that they send these people to credit repair shops, which we are not at all. But they send them there, and I hate, first thing they do is try to dispute everything to see if it comes off.
Yeah.
Or you're talking to a bar saying, oh, that's wrong. That's a mistake. And I'm like, all right, well, do you have a letter saying something? Well, no, that's a mistake. I wasn't past due. I'm like, well, you have to go call them and get proof. We're not just going to take your word for it.
Yeah.
And that's hard because a lot of times it is a mistake, and it's just not easy to call a giant credit card company and say, I paid this. Here's my canceled check. Here's the date it went out. Here's the date it came out of my account. You need this. And then they got to go check with a manager and and it takes like time to get that correction done. It's hard.
Yeah. I appreciate that. Chris, what did we miss? I mean, I got my one last question. And so it's just like basically on the credit and risk side of the industry. Like, how do you see that continuing to change? And then, if you could leave us, MMBBA, and the members with a key takeaway about credit or risk management today, what would it be? So where do you see the industry going? And then what's a takeaway for us today?
So where the industry is going is more and more data advancement, more and more automation advancement. So the most that you can import, the most that you can employ that strategy, I think the better you'll be off in the future. I remember talking to somebody back in 2016 when the data, the depository accounts came out, where you can, get bank verifications automated and all that stuff. I said, there's going to be a day where we put our handprint up and it's just going to approve us for our loan, because AI will go get everything it needs to get from where it needs to get it and approve it based on maybe an appraisal. And even that gets wiped out sometimes in certain cases, and a closing. So it's going to get that quick in the future. So keep that in mind. the more AI comes about and the more technology comes about, the loan process time frame is just going to shrink significantly. Where does the credit vendor play in that? We still provide the data that you need
Yeah.
for part of that decision-making process. So,
Got you. And then what's our takeaway?
Work with your vendor. There's lots of different pricing options out there that we didn't talk about. And talk about the different strategies and just pick the one that works for you. And if you think that something else is going to work better, investigate changing it. We're all partners in the same industry, and we all need to work together to get through all these changes. There's been a lot of changes, so we all really need to work together to get through them all. That's my takeaway. We really do need to work together to get through them all.
Hey, I love it. I love it. Hey, man. So this was great, Chris, and I appreciate you taking the time, sharing your insights today with us, for the work that you do. Your nonprofit. That's impressive as well. I want to talk to you more about that. We've spoken about it before, but I just didn't realize you wrote a book either, and how the course went.
It's not published. It's just sitting in my drawer.
Still,
And it's 20. It's like, I don't know. It's pretty old now. It's almost 20 years old, but it's still there. But the PhD loved it. It did create the course. It helped thousands of kids. I will go to any school that wants a 2-hour financial literacy seminar for their high schools. I mean, it's one of the favorite. Every May I go to a private school in Philly, and it's been almost over 10 years straight. And I speak to 200 seniors just before they graduate and go off to college. And every year they come back, and they love it. And I just love giving it because it's nice to educate them, because it's something that some of them have never heard. Like, a lot of us are fortunate to have financially responsible parents, but there's just as many people that don't. And it doesn't mean they're not well off. They just make enough money that they don't get it.
And you don't talk about it.
Yeah, they don't talk about it. So they got to hear it from somewhere before they go out there and make those mistakes.
That's awesome. So for everyone watching, credit plays a critical role in protecting our lenders, consumers, and the overall health of our market. Understanding how it's evolving helps all of us make better decisions. And so, again, thank you, Chris. Again, to you. Thanks again to CIC Credit, excuse me, as well as Bay Capital, as well as CMG Home Loans for supporting MMBBA Live. And thank you to our members for joining us. I'm Sean Williams, and thanks for being with us today. And we'll see you next week on MMBBA Live.
Thank you.